If you only knew the power of the dark side, it is your destiny.
Hello everyone, this is Take the Gate. It is September 10th, 2014. And this is an article on Wall Street on Parade. And it was written by Pam Martens and Russ Martens. And it was from September 4th. And it's titled, "The Fed Just Imposed Financial Austerity on the States." And I thought this was interesting because it's written in language that you would translate if you were a sort of a layman. And it's hard to grasp, so I'll just start reading it. The Federal Reserve Board of Governors, together with Federal Deposit Insurance Corporation, Office of the Comptroller Currency, top regulators of Wall Street's largest banks, finalized the liquidity means capital, rules yesterday that make absolutely no sense to anyone with a historical perspective on how Wall Street operates in a crisis. Capital is money, so the liquidity is the money. Federal regulators adopted a new rule that requires the country's largest banks, those with $250 billion or more in total assets, to hold increased level of newly defined high-quality liquid assets, HQLA, in order to meet potential run on the bank during a credit crisis. So they're asking for your mortgage if you can't meet the payments on these high-quality liquid assets to funnel cash to cities, states. In addition to the Treasury securities being stocks, bonds, commodities, and other instruments backed by the full faith and credit of the United States government agency debt, the regulators, those who are supposedly the cops, have included some dubious instruments while shunning others with higher safety profiles. So they have taken it upon themselves to take their own assessment and ignore others, basically, or on the same principle, and keep them from getting a higher credit rating. Bizarrely, the Fed and its regulatory siblings included the investment-grade corporate bonds, the majority of which do not trade on the exchange, and more stunningly, stocks over Russell 1000 as meeting the definition of high-quality liquid assets, while excluding all municipal bonds. Those bonds are city stock that they use to generate money, are being ignored. They will all be excluded. So if a city has, say, the gross domestic product of, say, a small country or small nation, it will be ignored in this. Even general obligation municipal bonds from states with high far credit standing and safety profile than the Better Business Bureau rated corporate bonds, this rightfully has state treasurers in an uproar. The 5 largest Wall Street banks control the majority of deposits in the country by disqualifying city bonds from the category of liquid assets. The biggest banks are likely to trim back their holdings in cities, Main Street, and this will raise the cost of, or limit of, the ability of states, counties, cities, school districts to issue city bonds to build those schools, roads, bridges, and other infrastructure needs. This is a particularly strange position for a Federal Reserve that is worried about subpar economic growth. So they're taking the money from these city bonds that they're using for those services and checking it to Wall Street instead of chucking it to Main Street. In the Fed rules statement for the Federal Register, it acknowledged public commenters' challenges to its inexplicable bias against city bonds while embracing all things corporate writing. Commenters asserted that the risk and liquidity profiles of municipal securities were comparable, if not superior, to the profiles of other types of assets the agencies proposed for inclusion of the HQLA, such corporate bonds, equities, and certain foreign sovereign obligations, and certain securities of GSEs. A number of commenters expressed concerns that the proposed rule would have included certain sovereign securities for countries that have smaller GDPs than some U.S. states as high-quality liquid assets, while excluding obligations of U.S. states and local governments. Some of these commenters argue that the credit rating of certain states compare favorably with those of countries whose obligations could be included as level 1 or 2A liquid assets. Commenters also contended that the municipal securities perform well and experience increased demand during times of stress. Several commenters asserted that the banking organizations could liquidate large holdings of city securities with minimal market or price disruption during a crisis scenario. So there's a crisis scenario on the rise, and they are preventing a run on the banks. That's what we know so far. Making the Fed position even more untenable is the fact that the Base 3 revised liquidity framework for the global standard of the new rules seeks to address and does not envision gutting city bonds from the mix of suitable liquid assets. The biggest hurdle for the Fed's position is that the city bonds are readily eligible for loans at the Fed discount window, trumping any argument that they could not command liquidity in a crisis. The Fed's rationale for including corporate bonds and stocks and not municipal city bonds in the high-quality liquid assets category rests on this premise. It rests on the premise that they want to chuck money at Wall Street while leaving Main Street to twirl in the wind and basically create this form of fake austerity through the artificial scarcity of capital. I'll just continue to read. The agencies believe that defining an asset as liquid and readily marketable if it is traded in an active secondary market with more than 2 committed market makers. A market maker is somebody that runs a hedge fund, basically. That's what they're amounting it to. Somebody with a vast amount of money that takes on debt. One of the last was Bear Stearns, which ended up belly up after it couldn't make its obligations. Large number of committed non-market participants on both buying and selling sides of transactions. Timely and observable market prices and high trading volumes provides an appropriate standard for determining whether an asset can be readily sold in times of stress. Bear Stearns took out loans, and municipal loans, they were rigged. The interest rates were rigged. So if a city took out a loan, paid into the future with interest, I took out $10, and I promised to pay you 20 to 30% on that $10. So that's $30 more, or $40 in the future from that $10 that I borrowed. So they're getting this money for 0.0001% from the U.S. Treasury to loan out to governments to borrow, to pay bills, and then getting killing in the future for having to pay it back. That's what these city councils are voting for. So when they can't meet that obligation, a hedge fund can't meet that obligation, they go to an insurance company like AIG. This is why AIG went under, and this is why Bear Stearns went under, because AIG could not underwrite the obligations that Bear Stearns had put out there. So, continuing along, that premise lacks a historical foundation. In times of crisis, Wall Street veterans know full well that the market makers have a nasty habit of backing away. Anyone who attempted to find large volume liquidity in NASDAQ stocks, money in NASDAQ stocks during 1987's crash would have been sorely disappointed. Relying on the market to provide liquidity in the midst of a new crisis event. The whole purpose of the Fed's new rules is to rely on tooth fairy principles. Within the Fed's own archives, we learned that on the day of the market crash in 1987, the market makers and over-the-counter markets were not obligated to maintain an orderly market and withdrew from trading. Delays in processing trades resulted in investors receiving prices very different from what they expected. Many brokers did not answer their phones, leaving investors unable to reach them. Erratic price movements and quotes resulted in frequent lockup of the electronic trading system used in the overall counter market. That was in 1987. Now, with $65 trillion floating around in hedge funds and derivatives, you get the picture. There was similar illiquidity in the markets throughout the credit crisis in 2008-2009. The Fed and its regulatory cohorts have resorted to implausible plans which crimps the ability of states and localities to raise essential funds for operation in an strained effort to pretend that they found a means of avoiding further massive bailouts for Wall Street in a crisis is just proof that this is only The only way to seriously deal with too big to fail banks is to restore Glass-Steagall and to break up these complex creatures before they strike again. And I would concur with that. Because when you have banks working as realtors, working as money markets, working as derivative holdings companies, and commodities, you're going to get massive theft on a grand scale. A grand scale. And who's left footing the bag? I'll tell you who's left footing the bag, the bill, whatever you want to call it. It is the full faith and credit of the United States government and us. This is Take the Gate. Please comment, rate, and subscribe.